This is another video from the channel, which is we are going to be learning about assets, liabilities, and owner's equity. And usually, this is one of the first lessons we learn in accounting because this is literally the basics that you are going to build upon to learn about accounts and all of the other things. So we are going to learn about assets, liabilities, owner's equity, and most importantly, the accounting equation. Because once you understand what the accounting equation is, basically you are going to understand everything else in accounting because it all links back to the accounting equation. Now, first of all, let's understand what an asset is. So, an asset is anything that a business will own that will uh, allow the business to benefit like financially from. So, for example, let's say you have a bakery as a business, and then in this bakery you have many things. Like, for example, you have an oven in this bakery, and obviously it is owned by the business in a way or another. And the thing about it is, this oven is owned by the bakery, and it helps the bakery to make the bread, for example, that they're going to sell. So it allows them to benefit from future economic benefits, right? So things like this. So recipe book copyrights, flour and eggs, obviously ingredients, these are also assets. Cash in till, so any cash you get from customers when they buy from you, that is owned by the business, right? Anything good that the business owns or receives and it's theirs, which can benefit them financially, is an asset. Now, finally, we've got receivables from customers, or which is current assets. So usually, if someone buys something from your business on credit, meaning they buy it from you, but they will pay the money later, that's still an asset. Maybe you still didn't get the money, but you must get it in the future. Now, there are two types of assets. There is current assets and non-current assets. Now, current assets are usually anything that the business owns and you can easily convert it into cash within 1 year, right? So things like this is obviously cash or any cash equivalents, account receivables, meaning people who buy stuff from us on credit, right? We might not have money from them yet, but we must be able to receive the money paid for to us for giving them the product or service as soon as possible, at least in 1 year. And usually we have to get these account receivables in 1 year. And if it doesn't, there's other cases which we'll learn about much later. And then inventory, so anything like stock. So let's say you have a retail business, and usually in a retail business, you have a stock of clothing, uh, things that you might not put on sale yet, but you're definitely going to put them sooner. So these will also end up being sold and converted into cash. Prepaid expenses. So, for example, let's say this bakery business, right? They pay their electricity bills for the next 4 months. Those are expenses, right? They still, for example, they still didn't get electricity they need for the next 4 months, obviously, because you're not living in the future. But that is a current asset, all right? So, and then we've got the non-current assets, and these are things that a business will own, but it will provide value beyond 1 year. So things like property, plant, and equipment. What do we mean by these three words? So property is anything like land, buildings, things like this that a business owns. Plant is basically any type of machinery, uh, industry stuff, anything that is to do with technology and stuff like this, that's plant. And equipment, all right? Those things usually it's not that much easy to see, like to see a value in the span of 1 year. And then intangible assets like patents and trademarks. Now, what is intangible assets? It's stuff that the business owns or money that the business owns that you cannot touch. So, for example, let's say you've got a business that you've invented something, and so what you're doing is that other people want to make the same business to sell the thing you have invented. So they have to buy patents from you. It's like copyright and goodwill. Now, what goodwill is, it's so imagine, for example, there's another bakery that is on the other side of the road. Now, your bakery, okay, has the same type of equipment and sells the same stuff on the menu, except they have better packaging, they have better customer service, and it's all about things that make them different to the other businesses. So usually, so think about it like Starbucks or Costa, for example. The cafes aren't any different than any local cafe. The only difference is uh, the brand image, for example. So they charge way more than local cafes, and that charging more is what we call goodwill. Right. Now, assets valuation. What happens with assets is that we usually, okay, record assets based on their cost or when they were initially recorded at their purchase cost, right? However, the thing with assets, some types of assets, right, their prices change over time. And these could be things due to deterioration or aging. Like, for example, we have something called depreciation. And this is something very important because we are in accounting, which will be a full chapter about it later in the future. So it is, for example, you've got a car and you bought this car. It's brand new. You bought it for 45,000 pounds or dollars, whatever your currency is. And then after 3 years, you go to sell it. Its value is going to depreciate, right? So what happens now is now going to be sold for 20,000 pounds, right? And the reason for this is because now the car is not operating the same as it was brand new. And it's same with intangible assets. We call that amortization. So, for example, you have an invention, right? Maybe you have invented the phone for the first time, and it was so we're just making assumptions here. It was just like a Nokia phone or whatever. And then, so you've got a patent. Any other business who wants to make a phone, they will have to pay you money because you're the one who invented it. However, as time passes, there's this invention has been uh, has gotten better by other people. So they have changed things in it. They have made something better than it. For example, Apple made smartphones and stuff like this. By the way, this is all like we're just assuming this is what has happened. So what happens is now the patent by Nokia has decreased or just isn't more of non-existent anymore. However, Apple just have it more. So it's all about things like this. Now, we're going to talk about liabilities. Liabilities is things that the business owes. So it is like an obligation, so stuff that the business is obligated to pay money for in the future. All right. So we have many different types of liabilities. For example, we have accounts payable. Now, maybe, for example, in your bakery business, you go to buy ingredients, but you buy them from suppliers, obviously. You don't pay them yet. You pay them in the future. So those are liabilities, obviously, because you owe them money. And then we've got wages payable. So any employees you have in your bakery, you have to obviously pay them wages weekly or their salary, monthly wage, anything like this. That is still a liability because you have to pay them. Now, VAT payable, that's taxes, uh, and it's usually what the bakery has collected on sales but has not paid to HMRC. HMRC is usually where the taxes are paid. Right. Then we've got bank loans. Now, bank loans, okay, so you, for example, take money from a bank and you pay them later, right? Uh, you pay them back, okay? And then we've got overdraft. Now, usually, for example, if you have a bakery and you have zero money in your bank account, but you still need to buy stuff, maybe. So what happens is that because your account is zero in the bank, you get something called an overdraft. And now that money you are borrowing it, except you'll have to pay a bit more in the future, which is something we call interest. It's applied to overdrafts and bank loans. And then we've got other things like lease liability, so amount of money owed for renting the bakery's shop, stuff like this. Unearned unearned revenue payments received in advance for larger cakes, and utilities payable, unpaid bills for electricity, gas, and water. So there are many things that we can think about when we are saying liabilities. Now, again, we have two types of liabilities, current liabilities and non-current liabilities. Now, current liabilities, these are obligations that the business expects to settle within 1 year. All right, so you have to pay them back within 1 year. Usually, these are people who you owe money, like suppliers, and we call that in accounting accounts payable. So these are suppliers, you buy from them ingredients, but you still don't pay them money. That is a current liability. Wages, that's obviously a current liability. Tax payable, current liability. Now, there's two different types of loans. We've got short-term loans and long-term loans. Short-term loans, along with overdrafts, these are current liabilities. We also have unearned revenue, which we just talked about in the previous slide. That's also a current liability. Non-current liability, on the other hand, it is obligations or money that the business has to pay back for more than 1 year. So you have more time to pay that money. And that's usually longer term loans, lease obligations, deferred tax liabilities, and pension obligations. Okay? Now, owner's equity. Now, I don't know why many people call it capital, which is completely wrong, but that's fine. So, what owner's equity is, it represents the owner's claim on the assets of a business after all liabilities have been deducted. So it's technically whatever assets you have in the company or the business, and then you minus from it all of the liabilities, all of the money you owe to other people, and then you get owner's equity. That's exactly how much money you have left, right? And this is where the accounting equation comes from. So it is, in other words, it just shows how much the owner truly owns in the business. And we will understand more what it is in the later slides, obviously. So we've got many parts of owner's equity. Owner's equity consists of these following four things. capital. So capital is money or assets the owner invests in the business, all right? So any sort of intangible assets or tangible assets, like, for example, PPEs, like uh, premises, plant, and equipment, those things, for example, is part of the capital. And then if we go back to the capital here, in the assets, for example, you've got inventory, you've got any sort of intangible asset, right? That is all under capital. Now, drawings. So, for example, you've got profits from or income from the company or business, and now that is part of your owner's equity. Now, the business owner or shareholders might take some drawings. That means they will take some money for their own personal use, which is their own income for working hard in their own business. And then we've got retained earnings. So these are profits so some parts of the profits taken yearly to reinvest into the business, right? And it's kind of obligatory, right? Instead of being withdrawn. So you can't have some drawings part of the income. Some of it should be retained to allow the business to kind of continue for the long term. And then we've got the additional contributions. That's just if you want to reinvest more of your drawings into the business. Now, we have the accounting equation, and this is kind of like the last thing in this video, which is the most important thing. Now, it is the fundamental equation in accounting. That means you have to know this, right? So it shows a relationship between assets, liabilities, and owner's equity. So what this equation is, assets equals liabilities plus owner's equity. Now, this equation must always balance, okay? So that means the business, what the business owns is financed either by borrowing liabilities or by the owner's investments. So you can't say like, okay, a business can own stuff without the owner investing into it or borrowing money to get it, because that doesn't make sense, right? So it's just common sense in this equation, really. So whatever a business owns equals whatever the business owes plus the owner's equity. All right. Now, why do we have this equation, the accounting equation? First of all, it is to ensure that the balance sheet always balances, which is the statement of financial position we talked about in the previous video, right? So remember when we talked about statement of financial position, where we include in it one side is the assets and the other side is the liabilities and owner's equity. And that's exactly how it's supposed to be, all right? So we use this to make sure that both sides of the balance sheet are equal. And then we've got forms of the basis of double entry accounting, which is very, very important. And there will be a whole video about double entry accounting, debits and credits coming soon. So stay tuned for that video because it is one of the bases of accounting actually. So it affects, so we will learn about this later, don't worry. And then we've got to help maintain accuracy and detect errors in accounting. So we can obviously see if the there is no balance in the accounts, that means we've done something wrong. So we can then find out what our error is. Now, there are some transaction types and effects on equations. So we have to understand the equation in a deeper level. For example, let's say the owner invests some money into the business. What does this do? It increases the assets because now that means the business owns more money, But it also increases owner's equity, meaning that the capital is increased as well. Okay? What if the business, right, takes a loan? Now, what happens is that now the business has more assets, so there is more money to use. However, now they also owe money to the bank or anyone else that the loan was given from. So that means two parts are increased, the assets and liabilities. And last time I checked that if the assets increase, which is on the left side of the equation, and the liabilities increase, which is on the right side of the equation, then the equation stays equal. All right. For example, purchasing assets with cash. Now, obviously, you are increasing your assets by buying more asset. But in the same time, because cash is an asset, you are decreasing your asset. So that's great because that means both changes are done on one side of the equation, which is the left-hand side, the asset side. So it's increased and decreased. So it's kind of like zero changes have been done, but we still have to account for it, obviously, to know the details for the changes that have been happening throughout the year. And then we've got, for example, if we purchase an asset on credit, so in this way, we are again increasing asset. However, we're not using money that we own. Instead, we are saying we are paying it later. So we are now liable to those people that we purchased assets from. So now increases in asset happens and also increase in liability. So you see kind of how this equation just balances no matter what. And then we have making a sale on credit that is going to increase asset because that means now your accounts receivable increases, and it's also going to increase your owner's equity, meaning increasing revenue. All right. Pay expenses, that will decrease asset because we are paying it, for example, let's say by cash, therefore assets decrease, sorry. But also owner's equity will decrease, right? Because it's an expense. Any expense will decrease owner's equity. So that was our video for today, and stay tuned for the next videos, and hope you are having fun, enjoying learning more about accounting.